Money market funds are a type of mutual fund. They invest in short-term, high-quality debt instruments. These include treasury bills, commercial paper, and certificates of deposit. They aim to offer high liquidity and low risk. Money market funds are popular among investors looking for a safe place to park cash. Their popularity has grown over the years. This is due to their perceived safety and stability. They are an attractive option for those who want to maintain liquidity. Retail and institutional investors alike favor them. Investors use money market funds as a cash management tool. They provide better returns than regular savings accounts, yet they maintain a level of safety comparable to those accounts. This makes them appealing during uncertain economic times. Money market funds are widely used in both personal and corporate finance. They help manage cash flow efficiently. Their increasing popularity underscores their importance in the financial world. Money market mutual funds operate by pooling money from many investors. This pooled money is then invested in short-term, high-quality debt securities. The primary goal is to provide investors with a safe place to invest their cash. They also offer higher returns compared to traditional savings accounts. Safety is a key feature of money market funds. They invest in low-risk securities. These are typically issued by governments or corporations with high credit ratings. This minimizes the risk of default. Furthermore, the Securities and Exchange Commission, SEC, regulates them in the United States. This adds an extra layer of security. Liquidity is another important aspect. Investors can easily convert their shares into cash. This makes money market funds an excellent option for emergency funds or short-term investments. The funds aim to maintain a stable net asset value, NAV, of $1 per share. The combination of safety and liquidity makes money market funds a preferred choice. They're especially useful for those who need quick access to their funds. This includes both individual investors and large institutions. Money market funds were created in the early 1970s. They were developed as an alternative to traditional bank accounts. At that time, banks were subject to interest rate regulations. These regulations limited the interest rates they could offer on deposits. Investors were looking for better returns on their cash. Money market funds emerged to meet this demand. They provided a way to earn higher interest rates. This was possible because they invested in short-term, high-quality debt instruments. The initial purpose of money market funds was to offer a competitive yield. They aimed to do this while maintaining a high level of safety and liquidity. This made them an attractive option for both individual and institutional investors. Over time, money market funds became a crucial part of the financial system. They offered a safe and efficient way to manage cash. Their success led to the development of various types of money market funds. Each type caters to different investor needs and preferences. The history of money market funds is marked by significant events. One of the earliest milestones was their creation in the 1970s. They provided an alternative to low-interest bank accounts. This marked the beginning of their popularity. In the 1980s, the collapse of Enron highlighted the importance of credit quality. Money market funds had to adapt to changes in financial markets. They became more cautious in their investment strategies. This helped maintain their reputation for safety and stability. In the 2008 financial crisis, money market funds faced challenges. The Reserve Primary Fund broke the buck. This event shook investor confidence. It led to regulatory changes aimed at increasing transparency and security. The evolution of money market funds continues today. They have adapted to new regulatory requirements. They also offer different types of funds to meet diverse investor needs. Despite challenges, they remain a popular choice for managing cash. Section 5. Regulatory framework governing money market funds. Money market funds are subject to strict regulatory oversight. In the United States, the SEC regulates them. The SEC's rules aim to protect investors and ensure the stability of the financial system. One key regulation is Rule 2A7 under the Investment Company Act of 1940. This rule imposes strict requirements on the types of securities that money market funds can invest in. It also sets limits on the maturity of these securities. This helps maintain the fund's liquidity and stability. Regulations also require money market funds to provide regular disclosures. This includes information about their holdings and performance. These disclosures help investors make informed decisions. They also promote transparency in the operation of the funds. Internationally, regulatory frameworks vary. However, the core principles of safety, liquidity, and transparency remain consistent. These regulations help maintain investor confidence in money market funds. They also contribute to the overall stability of the financial system. Section 6. Understanding breaking the buck. Breaking the buck is a term used in the context of money market funds. It refers to a situation where a fund's net asset value, or NAV, falls below $1 per share. This is a rare event, but can have significant implications for investors. The concept is rooted in the promise of stability. Money market funds aim to maintain a stable NAV of $1 per share. This stability is a key reason why investors choose these funds. When a fund breaks the buck, it means that it has incurred losses. These losses are significant enough to reduce the NAV below $1. The most notable instance of breaking the buck occurred in 2008. The Reserve Primary Fund's NAV fell to 97 cents. This was due to its exposure to Lehman Brothers debt. The event caused panic among investors. It led to a run on money market funds and increased regulatory scrutiny. Breaking the buck has serious implications. It can lead to a loss of investor confidence. This, in turn, can result in large-scale withdrawals from money market funds. Such events highlight the importance of maintaining high credit quality in fund investments. Section 7. Types of money market funds. There are several types of money market funds. Each type caters to different investor needs. The main types include government, prime, and municipal money market funds. Government money market funds invest primarily in government securities. These include treasury bills and other government-backed instruments. They are considered the safest type of money market funds. This is due to their high credit quality and government backing. Prime money market funds invest in a broader range of securities. These include corporate debt and bank obligations. They offer higher yields compared to government funds. However, they also come with slightly higher risk. Municipal money market funds invest in municipal securities. These funds are often tax-exempt. This makes them attractive to investors in higher tax brackets. They provide a way to earn interest income without incurring federal taxes. Each type of money market fund has its own features and benefits. Investors can choose a fund based on their risk tolerance and investment goals. This diversity allows money market funds to meet a wide range of investor needs. Section 8. Examples of money market fund instruments. Money market funds invest in a variety of instruments. These instruments are chosen for their high credit quality and short maturity. Some common examples include treasury bills, commercial paper, and certificates of deposit. Treasury bills are short-term government securities. They are backed by the full faith and credit of the United States government. This makes them one of the safest investments. Money market funds often hold a significant portion of their assets in treasury bills. Commercial paper is a type of unsecured short-term debt. It is issued by corporations to meet their short-term funding needs. Commercial paper typically has a maturity of less than 270 days. It offers higher yields than treasury bills but comes with more risk. Certificates of deposit, or CDs, are time deposits offered by banks. They pay a fixed interest rate over a specified period. CDs are considered low-risk investments. Money market funds use them to achieve a balance of safety and yield. These instruments provide the foundation for money market funds. They ensure that the funds can offer high liquidity and low risk. This makes them an attractive option for conservative investors. Section 9. Global comparison of money market funds. Money market funds operate in various global markets. While the core principles remain the same, there are differences in regulation and structure. These differences can impact the performance and safety of the funds. In the United States, money market funds are heavily regulated by the SEC. This ensures a high level of transparency and safety. European money market funds, on the other hand, are governed by EU regulations. These regulations also emphasize safety and liquidity, but have different structural requirements. Asian markets have their own regulatory frameworks. For example, Japan and China have seen significant growth in money market funds. These funds are popular among local investors. They offer a safe and liquid investment option in these markets. Despite regional differences, money market funds share common features. They all aim to provide high liquidity and low risk. Investors can choose from a variety of funds based on their regional preferences and regulatory comfort. Section 10. Benefits and considerations for investors. Money market funds offer several benefits to investors. One of the main advantages is liquidity. Investors can easily convert their shares into cash. This makes money market funds an ideal option for managing short-term cash needs. Another benefit is safety. Money market funds invest in high-quality, short-term securities. This reduces the risk of loss. They are considered one of the safest investment options available. However, there are also considerations to keep in mind. Money market funds offer lower returns compared to other investment options. This is due to their focus on safety and liquidity. Investors seeking higher yields may need to look elsewhere. Additionally, while money market funds are generally safe, they are not risk-free. The risk of breaking the buck, though rare, is one such example. Investors should be aware of these risks and choose funds that align with their risk tolerance and investment goals. Section 11. Conclusion. Money market funds play a crucial role in the financial world. They offer a safe and liquid investment option for managing cash. Their history and evolution reflect their adaptability and resilience. Despite challenges, they remain a popular choice among investors. Understanding the different types of money market funds and their regulatory frameworks is essential. This knowledge helps investors make informed decisions. It also highlights the importance of safety and liquidity in these investments. While money market funds offer several benefits, they are not without risks. Investors should carefully consider their investment objectives and risk tolerance. This will help them choose the right money market fund to meet their needs. In summary, money market funds are a valuable tool for managing cash. Their safety, liquidity, and stability make them an attractive option. With proper understanding and careful selection, they can be a beneficial addition to any investment portfolio.